Hi, everyone. Thank you for joining us today on a very beautiful weekday lunchtime. And thank you for taking a time out of your week to hear more about Keppel REIT. So today we will be hosting Keppel REIT's management, and they will be giving an update on their business and their prospects for the audience. So Before we dive in, let me just go through some of the slides for the introduction to the speakers, and then we can get kicked off. Throughout the webinar today, if there are any questions that you may have, please just pop them in the Q&A box in Zoom throughout any time, and we will get to those at the end with management. So before we start, I'd like you to just take a little bit of time to meet our speakers, Mr. Ko Wee Lee and Ms. Kang Leng Hui, who will be CEO and CFO respectively of Keppel REIT. Very storied careers and a lot of experience in the financial space as well as in the real estate space throughout Asia Pacific, as you can see. So a little bit more about us as ProsperUS as a brand. We are a digital native first broker, online broker. We have no minimum commissions on SGX trades, so please do check us out and build a long-term portfolio with us. Invest on the go with our app on both the App Store or Google Play. And you can build a portfolio using the Build app, which is a bit more long-term focused, or the Boost interface, which is a bit more of the trading mentality focus, if that is your preference. Come prosper with us by following us on the social media. We are on Instagram, we're on the Telegram, LinkedIn, all the major ones. And obviously visit us on the ProsperUS website, where myself and my colleague Billy have a lot of educational content and inspirational stock ideas as well. And then finally, please follow me for more insights. I have my own weekly newsletter talking about investing in Asia, making it a bit more accessible for the everyday investor. And on Instagram, I'm on Tim Talks Money, and on TikTok, I'm on Tim Talks Money SG. All right, so without any further ado, I will hand over to Ms. Kang Leng Hui for the breakdown for Keppel REIT. So please take it away.
Yeah. Hi everyone. Thanks for joining us today, especially during lunchtime, for our investor presentation today. Yeah, so I will just start off with our next slide on some of our key highlights for the first quarter of 2023. So on this slide, you can see that we continue to see very strong operating metrics that see stronger NPI or net property income across most of our properties. Our portfolio committed occupancy remained high at 96.3%, and portfolio's weighted average lease expiry remained long at 5.8 years, with our top 10 tenants WALE at 10.3 years. On the 3rd of April of 2023, we announced the practical completion for Blue and William, and that is our freehold project in North Sydney that will start contributing to Keppel REIT's income. And moving on to our capital management, as at the end of the quarter, our aggregate leverage was about 38.7%, while our first quarter's all-in interest rate is about 2.86% per annum. Our borrowings on fixed rates was 75% as at end of March. We have also resumed our unit buyback exercise on the first quarter and purchased a total of about 9.5 million units, which were subsequently cancelled during the quarter. On the next slide, as you can see, we are supported by our very healthy operational performance. Our property income and net property income for the first quarter 2023 has increased year on year. Keppel REIT saw an increase in net property income for most of our properties due to higher rentals achieved and also higher actual portfolio occupancy. Similarly, there was an overall increase in NPI contributed by the associated companies. This was due largely to the higher occupancies, as well as the increase in service charge income to cover the higher property expenses of One Raffles Quay and Marina Bay Financial Centre. However, there was still a drop in the share of results from these associates, mainly due to the impact of higher interest expenses. Our share of results from joint ventures increased mainly due to the commencement of new leases at 8 Chifley Square, and that was partially offset by the depreciation of the Australian dollar against the Singapore dollar. Due largely to a higher borrowing cost, distributable income from operations was lower year on year at about 50.2 million, including the anniversary distribution. Distributable income for first quarter of 2023 will be 55.2 million, and there is a 2.6% increase year on year. On the next slide, So at Keppel REIT, we adopt a prudent capital management strategy. As mentioned just now, our aggregate leverage is healthy at about 38.7%, all-in interest at 2.86% per annum. And borrowings on fixed rate will maintain at about 75%. And where practicable, we will adopt a natural hedge policy by matching the currency of our borrowings to those of the assets that we are investing in. So Australian dollar, Korean won, and Japanese yen denominated loans form approximately 16%, 4%, and 3% of our total borrowings respectively. Our sustainability-focused funding was increased to 62% of our total borrowings as at end of the quarter. And there is no major refinancing requirements for the rest of 2023, with most of the debts coming due for this year maturing only in the fourth quarter. So now I will hand over this deck to Willie, our CEO.
All right, thanks, Ling Hui. So on to slide number 7. As you can see, this shows the Keppel REIT's portfolio breakdown by different geographical locations. So Singapore remained Keppel REIT's biggest market at close to 80%, while Australia, Seoul, and Tokyo are at 17%, 3%, and 1% respectively. So these quality assets are distributed across different markets, which will enhance Keppel REIT's income stability and provide long-term growth opportunities. So as the end of March 2023, our portfolio is around $9.1 billion. Going on to slide number 8 itself, we committed a total of more than 200,000 square feet of space, or over 74,000 square feet of attributable space during the first quarter of 2023, with a high retention rate of 98%. New leasing demand and expansion were mainly from the banking, insurance, and financial services, accounting and consultancy services, and energy and natural resources, and shipping and marine sectors. As at the end of March, Keppel REIT's portfolio committed occupancy remained high at 96.3%, and portfolio weighted average lease expiry remained long at 5.8 years. Going on to slide number 9, Keppel REIT's lease expiry profile remained well spread across the years. Supported by steady leasing demand, portfolio rental reversion for the first quarter of 2023 was 9.3%. The weighted average signing rent achieved for our Singapore CBD office leases was $12.05 per square foot per month, which is higher than the average core CBD Grade A office rent of $11.75 per square foot per month. Remaining expiries for 2023 is low at 7.1% by attributable net lettable area. This slide shows our established and diversified tenant base, comprising established blue chip corporations and government tenants. Going on to slide 11, Blue & William achieved practical completion on 3rd April 2023 and will start contributing income to Keppel REIT. As mentioned in the previous quarter, Blue & William has secured Equifax as an anchor tenant, and the developer is providing 3-year rental guarantee on the unlet space. We're in discussion with a few prospective tenants for the remaining space. Moving on to slide 12, we are proud to announce that the additional ESG credentials achieved during the quarter. 8 Exhibition Street achieved the Wire Score Platinum rating, the second property in our portfolio to achieve this rating. In addition, Keppel Bay Tower achieved Smart Score Gold rating for its smart building features. Moving on to slide 13. At Keppel REIT, we recognize the strategic importance of our sustainability and strive to embed sustainability into every aspect of our business. Where applicable, quantifiable ESG targets have been set, and we remain committed to these targets. With that, I've come to the end of my presentation, and I'll hand the time back to Tim.
Okay, thank you, Willie, for that. I guess we actually would like to start with a question. We have one question from the audience. So maybe we can start with that one first, and then we can go from there. We also have some questions prepared by our team at ProsperUS, which we would also like to bring up. But I would just remind anyone in the audience, please do pop your questions into the Q&A box at Zoom. Just ask whatever. You can be anonymous. You can ask whatever you would like to Wheelie and to Leng Hui to kind of answer any questions on Keppel REIT. So I think maybe we can get started with the first question, which is, okay, so Keppel Corp unbridled enthusiasm to increase AUM. So I think this is part of Keppel's maybe transformation plan or sort of business transformation plan where they aim to increase the AUM by up to 200 billion, over I think maybe 2026 or 2025. So I think being one of Keppel's main listed REITs, the assumption is you'd have to play your part in fulfilling this AUM ambition. So for unit holders of Keppel REIT, do they have to worry about this development for Keppel Corp's larger, AUM target by 2030 rather, or is it, at least in part, an incessant, unabating EFR through its REITs? I mean, what's your take on that?
Yeah, thanks, Tim. So definitely, I think Keppel Corp, I think with this, they've announced the target AUM this. So we are one of, I think, Keppel Corp's, listed vehicle together with Keppel DC as well as, their KIT and things like that. But beside all this listed, we also have other unlisted funds, right, that is not known to the general public. We have the Alpha, as it's the private equity fund in real estate. We're also launching, I think, new, very dedicated kind of funds like in healthcare and student housing, so on and so forth. Besides that, there's also infrastructure, which is actually seeing quite a bit of growth. We definitely hope to be part of this, be able to contribute to the 200 million. But more importantly, I think as a listed entity with independent board itself, we always look after shareholders, right? I think we want to grow, but I think priority is, of course, to grow DPU as well as AUM itself. And we only do deals that is the interest of unit holders.
Okay, thanks. Okay, I think we can move on to the second question. So what are the trends, for example, I guess hybrid office, that you see impacting Keppel REIT? Because obviously there's been a lot of talk about office and work from home trend, and that's impacted the US, but I think Asia is quite different. So how may it impact each market that you operate in, and how are you overcoming it?
Yeah, Tim, you're spot on. I think this work from home trend, I think pretty much, for those of us working in the CBD, you can feel that things are pretty much back to normal, or even have things feel more crowded than pre-COVID itself. I think you see long lines waiting at food outlet. Public transport is crowded, congested, and things like that. And for us, I think most of our tenants are giving the employees some option to work from home 1 or 2 days, but I think they find most of their employees back in the office. And so that's generally the same for Singapore. But likewise for the rest of our market, for Keppel REIT, we focus on Asia Pacific. We're in Singapore, obviously, Australia, Japan, and Korea itself. Japan and Korea, pretty much, I think things are back to normal as well. Australia, a little bit slower, but I think things are stable. I think recently we have made trips to Australia to meet with our partners as well as tenants. And again, I think most companies there are practicing, again, giving employees flexibility of having 1 or 2 days work from home. But Sydney CBD definitely feels very crowded. Again, you can't get into a nice restaurant without prior booking and things like that. So while they may be slightly behind us, they are definitely on the track itself. So I think in the Asia Pacific market, we don't see much threat the way of going to the US, where you only see 25% occupancy. In fact, I share with the audience today, I think our portfolio occupancy remains high. And in fact, I think we're proud to say that some of our properties, like One Raffles Quay, have achieved 100% occupancy. So that's a testament, and we are still able to achieve positive rental growth by 9.3% for the first quarter itself. So I think Asia Pacific is a very, very different story from North America as well as Europe. And we don't see there's any risk of us going either way. Yeah.
Okay. All right. So I think we can move on to the next question. Okay, so this is probably similar to what you just answered. So how's Keppel REIT affected by the negative sentiment in US office property? And we also have one that's, I guess, a bit more related to your portfolio. Do you see the same risk for US office space happening in Australia? I mean, we talked about Singapore. It's probably not the case in Singapore because, as you discussed, it's back to normal. It seems back to normal in the CBD. But is that the same case in Australia as well?
Yeah. So again, like say Australia, like what our personal view as well as what is validated by the I think occupants there is, no, I don't think it will go the same way as the US itself. Like I mentioned, when we go to Sydney and Melbourne markets, things are pretty much back to normal. I think the employees are gradually going back to office. In fact, to quote anecdotally, I think National Australia Bank and the CEO came out and tell the employees to come back to work, or if you choose not to, I think maybe they should find another job. Some corporate leaders have taken very hard stand on that. But again, on the ground, we do see that definitely most employees are back. Definitely, you see maybe Friday a little bit more quiet, but rest of the week, I definitely the CBD feels very crowded. So I don't think Australia is in any risk to go the way of the US for now. And as in the negative sentiments, the US office property definitely affect us. I think generally we have seen that the US, those property funds itself underweight in a lot of offices. So I think that may be an impact on why our unit price is affected. But in times like this, I believe in going to the fundamentals, and the fundamentals for office in Asia Pacific, particularly in Singapore and the rest of the markets that we're in, continue to be strong. Like I said, we have confidence in our properties, confidence in our product. We are in the prime office space. We are not in the commodity office. And what we're trying to do actually over the past couple of years have to be increase the amenities to our properties, upgrade where we're carrying out, asset enhancements to continue to make our properties contemporary and relevant to tenants. And I think people want to come back to office, right? To quote one of my tenants, they say that their clients pay them for performance, and they can only perform best when they work together. Yeah.
Okay. Thank you for that. I think we've got a question on asset types from the audience as well. So I think let's just put that up. Okay, so any plans for Keppel REIT to diversify into other asset types, etc. Malls? I guess this is sub asset types. Malls, business parks, as office assets are, I guess, typically viewed as cyclical.
Yeah. So for us, definitely, I think the mandate is actually to invest in commercial assets in Asia Pacific and recognize our strength in particularly the office, the prime grade A office sector. I think we have been focusing on that, and that has actually served us well in the past itself. So we have actually ventured into business park in Australia. And as for malls, not really, but we have in part of our so-called product or service offering to our tenants, just like Marina Bay Financial Center, there's a Marina Link Mall there to provide amenities to the tenants itself. So we can also potentially invest in mixed-use development that have other components that will enhance the overall product or service offering of our properties itself. But I don't think we'll pivot to a purely kind of retail mall kind of stuff, but to focus again, recognizing our strength in the commercial grade A office sector itself, and maybe to add adjacent kind of things to this core portfolio.
Okay, thanks for that, Wee. We have a question actually on fundraising. I guess REITs generally have to raise funds or have to take on debt to fund acquisitions and grow. So do you foresee any fundraising in the next 12 months for Keppel REIT?
Yeah, I'll start this first, and then maybe I'll invite my CFO to answer itself. At this point in time, obviously, I think the unit price is trading at quite a wide discount to NAV itself, and like I said, we have currently no plans to raise funds in the next 12 months. In fact, I think I'll let Ling Hui share a bit more on our share unit buyback as well.
Yeah. So definitely. I mean, we are trading at a discount, and I mean, just now during the presentation, I have also emphasized that our aggregate leverage is about 8.7 at the end of the quarter, And I think with that, actually, we do have quite a good debt headroom without having to tap the market, the equity market immediately. I think just to our 45% aggregate leverage, it will be about more than 1 billion, and to the 50%, which is mandated by MAS not to exceed, is about 2 billion. So I think that gives us, we are actually in quite a good position, not under any immediate pressure to fundraise. And I mean, if on the other hand, on capital management perspective, we are also buying back units and cancelling. So that immediately will actually have an impact to our DPU. Is actually DPU accretive.
And maybe just to add to what Ling Hui has said, I think in the current environment, obviously, I think the focus is on capital management as well as asset management. Like say, we still have very good kind of tailwind behind us, as seen from the rental growth itself. Definitely, I think some of the space that was given by the banks, I think beginning of last year, will lease out very well. That's why we're able to capture huge, I think, rental upside. So we continue to be focused on, like say, the interest rate environment is something that affects everybody and beyond our control. But all we can manage is within our portfolio to do well, continue to deliver the kind of DPU, to the unit holder.
Yeah, that makes sense. Okay, I think we have one on just the general office REIT sector for Keppel REIT. So among the office REITs, among the REITs rather, why do office REITs seem to underperform and stay low? Do you think things might reverse? Obviously, we had COVID, but then we're coming out of it now. So is this something that you're hoping will, obviously you're hoping will reverse, but when do you think this will be able to happen?
Yeah, I wish the reversal could be yesterday, right? So, I mean, honestly, again, this is a question that I think puzzles a lot of people. But I think, again, if you go back to look at the North American, European market, I think probably that's where the genesis is. I think there's a couple of reasons that people try to put up to it. Maybe to dial back a little bit into history, pre-COVID, I think 2019 or so, actually, if you recall, I think some of the co-working space, the likes of WeWork, I think was a big I think occupant in the US office market itself. And in certain segments, they even lease as much as like close to 20% of this. But obviously, you know what happened during the COVID, and this kind of business model is impacted and leads to definitely huge vacancy in a lot of the buildings. I think, like say in Midtown Manhattan itself, some of the buildings are only 25 or 30% occupied. So I think they create some negative sentiments among a lot of the US and European investors. I think European may face some of the similar situations, and probably they think that Asia is probably just behind the curve itself. But looking at Asia Pacific, I think obviously Singapore roll out of the COVID in a very strong way, but continue to be strong. And for us, it's not. I don't think we're in a bubble. I think in Singapore is supported by really strong fundamentals. First, I think again you look at the global economy with tension in North Asia itself and uncertainty in the West itself. A lot of people actually refocus on Southeast Asia, which is one of the few bright spots here. So I think coming to Southeast Asia is quite natural if people choose to set up their HQ in Singapore. So there's one driver of office demand. And coming out of COVID, obviously a lot of companies are keen to grow their business. So that also leads to a lot of demand for our quality kind of office space. And one consistent theme throughout this thing is the flight to quality, whether is it Singapore, US even, or even Australia. We see that, because employers are keen to bring their employees back home. So they sometimes they will take up smaller space, but go for better quality space with good amenities to encourage their so-called employees to come back to work. That's one part, right? The other part in Singapore also, I think the URA has also mentioned recently that they are not releasing any more land parcel in the CBD anytime soon, right? So that also to help manage the supply situation. But even if we give a scenario, say today they put out a land parcel, to build a new office tower, really at least it'll take at least 5 years, right, for new supply come up. So the limited supply is helped. Of course, we also benefited from some migration of the corporates from North Asia itself. So I think in Singapore, I think really supported by strong fundamentals. So again, I think sometimes stock market, the beauty of it is it may price wrongly, but therefore create a good buying opportunity. Again, I think in this kind of circumstances, where there's so much volatility and uncertainty, we focus on the fundamentals. And the fundamental, I would say, impacting Singapore office is strong. So in my opinion, I think it's just a temporary kind of mispricing here.
Mispricing, yeah. Okay, thanks. Thanks for that explanation, Willie. I think we have another question on relating actually to what Lan Hui had said about buying back units, canceling them, which generally is positive for shareholders, for unit holders. So you've been doing that, but Keppel Corp has stated they want to increase the AUM to 200 billion by 2030. So how do you reconcile those two actions?
Yeah, so I've explained on the buying of units and cancelling them. So we take that as a capital management tool to manage our units that we have, and is DPU accretive. So that actually uses a portion of our debt headroom as well. So on the increasing of the AUM, I mean, it's merely it requires the source of funds, and where do we then use our funds, our balance sheet for. So I mean, in terms of increasing AUM, doesn't mean that we have to borrow entirely to increase. I mean, throughout all these years, we actually have been very active in our portfolio optimization. What that means is that we have also been able to divest some of our older assets, or rather some of the assets that we have acquired in the past. I mean, in fact, most of the IPO assets or the listed assets since the day that Keppel REIT has been divested, and that gives rise to capital gains that we are able to distribute to shareholders. And with that, with some of the proceeds, we are able to then redeploy into more assets over the years, and that is a way to increase AUM. But that said, it doesn't mean that we are always increasing. I mean that at the point that we divest, actually our AUM will also come down a little bit before we go up. So actually it takes us through a number of years to be where we are today, where we are about 9 billion. I mean, 2006 we are, we started off with less than about 1 billion. So it's really through this portfolio optimization that we're able to grow.
Yeah, and again, to add to what Ling Hui has said, and I also mentioned this briefly, when Keppel Corp's target to add AUM, I think we are just one of the funds under Keppel Corp itself. There are other units, and more importantly, they want to grow the private kind of equity real estate business, the other fund under management. Not just real estate, but also including infrastructure itself. So the AUM is not just restricted to us. There are other initiatives that are in place itself. Again, emphasize that, definitely, I think Keppel Corp being the largest shareholder in Keppel REIT, interests are totally aligned with all the unit holders here.
Okay, thank you. We have a question related to interest rates. Interest rates looks like they're higher, they're peaking, but are they going to stay high for longer? That's the big question. So in this current interest rate environment of higher for longer, how's the REIT growing its DPU? And then we had another question, which is very similar about, how interest rates will actually affect profit and then perhaps DPU in the coming years, and if so, by how much? Is there could you shed any light on those questions, on answers to those questions?
Maybe on this, I will more focus on our fixed rates ratio. So we are 75% hedged as at this point in time, which means that we are only exposed to 25% of our borrowings on the higher interest on floating rates. And when we look at our fixing our interest rate, it doesn't just happen when the rates have increased. It's done through over the years. I mean, in fact, we have hedges that are done at 1% or 2%, and even in 2021 we have locked in or raised medium-term notes, 7-year medium-term notes at about 2.07%. So that kind of put us in a very stable and given more certainty on our interest rate in the upcoming years. So that's why if you look at our all-in interest rate, we are still at a very healthy position. We're at about 2.86%, despite let's say Sing dollar SORA moving closer to 4% these days. And what is our expectation for the longer term? We do believe that it is likely to remain at about this level. I mean, we are hoping that the Fed will pause the interest rate hikes in the second half of this year. But we do expect that overall our all the interest rates should be about 3% or crossing 3%. But in terms of sensitivity, it's not going to impact us that much. I think we have also shown in our slide on the sensitivity for any increase in 50 basis points, it will hurt us by about 2% in DPU. But of course, on what are we going to do to grow our DPU, we definitely will be looking at our top line growth. Rental will continue to be strong. So that will actually be able to kind of give us some protection on the impact on interest rates. And just now I've mentioned that we have also given a tranche of anniversary gains that will be spread over 5 years. So that to a certain extent will also help to support our DPU.
Okay, thanks. Okay, I think we have a couple questions which I think we can probably combine into one actually, because they're related to each other. So the first one's related to China office. China's reopening. Would you consider adding China office space to the portfolio? And then I guess related to that, or following on from that, what is the REIT's broader growth strategy moving forward?
Yeah, so again, right now, focus on the more developed markets in Asia Pacific, Singapore, I think Australia, Korea, and Japan. We are not looking into China at any time, and I don't think in the short term we are venturing into China or Hong Kong anytime soon, right? I think China still need to probably work out some of its real estate woes before being, before we consider even entering the market itself. In terms of long-term growth strategy, again, like say, good thing that Singapore, I think the office market is strong. We are seeing rental growth, so we try to capture as much of the organic growth as possible. But long-term wise, definitely, I think we continue to stay active and look at evaluate situations. Like for Australia, some of the deals recently done, I think is showing that becoming so-called in a more accretive nature. That means that you can buy things that will giving a higher yield than the interest cost itself. So we're keeping close tab of the market, but we're not rushing in itself. Again, I think we want to continue to maintain the prudence and discipline that we always have. Again, this low interest environment is just the last couple of years, but Keppel REIT will soon be celebrating its 20th anniversary. And during the past 20 years, we have gone through a lot of cycles, right? Up and down, stuff like that. So I believe, and with the strength of our sponsor, we will be able to navigate this volatile period and emerge stronger and more successful.
Okay, thank you for that. I think for the audience, that is the final questions. So I would like to thank Wee Lee and Leng Hui for joining today and giving a bit more in-depth insight into Keppel REIT and the growth prospects. And I hope everyone enjoyed their sharing. We will be hosting more REITs in the future at ProsperUS, so please do keep a lookout for that. And until next time, thank you again, Wee Lee and Leng Hui, for joining us today. And thank you, everybody, for taking time out of your lunch.
Thank you very much. Thanks, team. And thanks for CIMB for organizing this. All right. Have a great day ahead.
Everyone, cheers. Bye. Bye.
Bye-bye.